Today I would like to analyze General Mills, one of the biggest food companies in America, and if we take a look at the stock price, we can see we are up 22% in the last 5 years, but if we take a look from 2023, we are down about 33%, and we're going to take a look at the financials to find out if this company is undervalued right now. The first thing we can recognize is a market cap around 33 billion US dollar. This makes this company the 13th biggest food company by the market cap. And we also have a dividend yield around 4.05%, which looks very attractive. We can see here as well the dividend did increase for some years in a row. And it's also had some good growth in some years. So it looks interesting. We're going to take a look at the financials now to find out if this company is undervalued. The next thing we're looking for is free cash flow growth in the last 5 years, a very important number because the free cash flow can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So we want to see that grow. And in 2020, General Mills had a free cash flow around 3.22 billion US dollar. This was a 41% increase. Then in 2021, we had the 23% decrease, probably related to COVID. Then in 2022, we had the 12% increase again. Then again, the 23% decrease in 2023. And then in 2024, we had the 21% increase. So overall, the free cash flow is very inconsistent. And we can also see here the operating cash flow decreased as well in 2021 and 2022. And we can see here we have the capital expenditures increasing over the years. So they're investing more in the business. I'm not sure it's a good thing or a bad thing in this situation because it's already a very big company. So overall, it's not a check here. Now we would like to see the free cash flow yield over 4%. This can also tell us about the valuation of this company. If it's under 4%, it can mean the company is overvalued. So what we're going to do is we're going to take the free cash flow in 2024. Around 2.53 billion. Then we're going to divide it with the current market cap of 33 billion. And then we're going to get the free cash flow yield for 2024. The number we get is around 7.66%, which is a great number. They have a lot of free cash flow and this is really good. We can also say they can pay the dividend. The dividend is around 4.05%. The free cash flow yield is way higher. It means they can pay the dividend and they also have money left to invest in the business, to pay back the debt, or to use it for stock buybacks. So as a check here, it does look undervalued from the free cash flow yield. Now we would like to see the debt to free cash flow ratio under 5. This means the company can pay back the debt with the free cash flow in under 5 years. A very important number because if a company has too much debt and cannot pay back the debt, it risks to go bankrupt. So we don't want to see that. And we're going to take a look at the short-term debt first, around 1.73 billion. Then we're going to add the long-term debt as well, around 11.3 billion. And then we're going to divide it with the current free cash flow, about 2.53 billion. And the number we get is the debt to free cash flow ratio for 2024. So it's around 5.15. So this means a little bit over 5 years, we can pay back the debt with the free cash flow. So this number is okay, it's not great. I would still say it's a check. Of course, we would like to see it. Okay, it's not a check, but it's close. Let's say it's close. So it's close to the 5 years that we want to have, but it's not so bad actually. And we can also take a look at the cash on hand. They have around 400 million in the bank, which is okay, I think. It's not a great number, but it's also okay. So overall, the balance sheet is okay. It's not great. The next thing we're looking for is the enterprise value to free cash flow ratio under 25. This can also indicate if the company is undervalued. So what we're going to do is we're going to get the enterprise value. This is the current market cap plus the debt and minus the cash on hand, so how much money the company has in the bank. So the number we get for the enterprise value is around 45.63 billion. Then we're going to divide this number with the current free cash flow, around 2.53 billion. and then we're gonna get the ratio. The number we get is around 18. So this is a great number. It's under 25. So it can indicate that this company is undervalued right now, and it's a check here. The last thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that especially if we think the company is undervalued, because it can help the stock price to increase. And we're going to take a look now. We can see now they did buy back a lot of their shares. We can see here around 1%, then 2%, then over 2%, and then around 4% in 2024. So this is a good rate. I would say they buy back a lot of their shares. Is a check here, and we like to see that especially we think this company is undervalued. I would like to give my conclusion about this company. So let's start with a positive. So we had the revenue growth in the last 5 years. This is something we really like to see. We also have the free cash flow yield around 7.66%, which can indicate that the company is undervalued. And also the enterprise to free cash flow ratio is around 18, which again indicates that the company is undervalued. We also have a dividend yield around 4%, which looks attractive. Then we have the stock buybacks, which can help the stock price to increase. This is something we like to see as well. What we don't really like to see is the balance sheet, because it has a little bit too much debt and not a great amount of cash on hand. And also the free cash flow decline is something we need to consider. I think if the company can increase the free cash flow in the future again, it's a really good buy right now. And we also need to consider if this company has a strong brands. This is something important at the end of the day, because we need to have the customer buying their products.